In today's video, I'll be showing you the ultimate guide for investing in your 20s. I'll be showing you my top 5 tips to make sure that your 20s are as productive as possible and that you can use this time to set yourself up for your future. When you're in your 20s, it can seem like it's not a very important time to think about money, and you'll have a lot more time later in life to start considering your finances. But in reality, your 20s are an excellent time to build good habits and can make sure that you set yourself up later in life, and the time that you put in early now can really dictate how your life is later down the line. So I think it's a really important time to make sure that you set up good principles and good spending habits to make sure that you don't shoot yourself in the foot as you get older. Keep in mind, this is just my personal opinion. I'm not a licensed financial advisor, so make sure to do your own research and take everything I say in this video with a grain of salt. If you find the video helpful, make sure to drop a like for the YouTube algorithm and subscribe to the channel so you can stay updated with future content. Firstly, don't spend money on things that you don't need. When you're in your 20s, you often think about what you can buy. What are the new things that you can purchase with your money? Often it's clothes or cars, but really those things are just superficial. They only give you a little bit of satisfaction, but it's only temporary. Once you buy those new shoes, you might be happy for a few days when you get to wear them, but quite quickly that happiness wears off and you just get to your baseline again, and you need to buy something more expensive to get that same feeling again. If you look at all the clothes or electronics or cars that you may have had over the years, and how much of that do you really use now? If you could turn all of that back into money, think about how much better that would be for you. It might feel good to buy a new phone every year, but in 10 years time you're not going to remember these things, and it's going to feel a lot better to see an extra zero in your bank account or to see your profits rising from your investments that you've made. Seeing your money grow and actually work for you is a lot more satisfying and will actually bring you a long-term benefit. Don't get me wrong, buying things is nice and can be fun, but it can't be the only thing that you plan on doing with your money. You can't think as soon as you have some spare money in your bank account about how you're going to spend it and what you're going to buy with it. It only leads to short-term satisfaction, and it's not going to give you any long-term benefit. Number 2 is don't take on debt. This is mainly in the form of credit cards, which in 2021 had an average of 16% interest. This means you're always going to be paying extra money for things, and normally with credit card debt, it's for stuff that you don't need, like clothes, cars, or expensive vacations. If you spend $1,000 on clothes with a credit card on that 16% interest, then really you've paid $1,160, and this will just constantly eat away at your money. And if you rack up a large credit card bill and take several months or years to pay it off, then that interest will always grow over time and you'll be paying more and more money. Don't go balling out and spending as much money as you can and always looking for new things to buy, because it may be more or less accepted in society to have debt. It's not something that you should have just because other people take out loans to buy things. You don't need to follow suit and do the same as them. Ideally, living below your means is always the best way, because it'll ensure that you don't spend more money than you have. If you live between 10 and 20k less than what you make a year, this will always make sure that you hold on to a good portion of the money that you make. If you just increase your spending to accommodate how much your salary increases, then you're always just going to be shooting yourself in the foot and never being able to hold on to any of that extra money that you make. Your priority should always be to pay off your debt before you buy something new. And if you're interested in getting better with your money, you need to make sure that you pay off all the debt that you have, especially if you have interest on that debt, and this will mean that it will always grow the longer you leave it there and the longer it takes for you to pay off. Debt can also be an issue when you take it out for studying. Just because society says that you should go to university and this is the path that you need to take to be successful, this isn't always the case. You need to factor in the job availability for what you want to study and what the upper threshold is for how much money you can make in that particular field. If you take out a $60,000 loan to study a degree where there's a lot of job scarcity and the starting rate might only be $50,000, then you need to ask yourself, is that really the best option to take? But if you can get a job quite quickly and say the upper threshold is about $80,000 to $90,000, then over the long term that debt will be worth it, because over that period of time you'll be able to make more money and gradually pay off that debt. So keep that in mind when you're thinking about going to university, because it can put you in crippling debt, especially if you can't actually secure a job or one that pays well in that field. Number 3 is don't overcomplicate things with investing investing. Investing is very straightforward and it's not something that takes a lot of time, effort, or knowledge. If you invest in broad stock market indexes like the S&P 500 ETF, which is just a collection of the top 500 biggest publicly traded companies in America, then you can secure yourself a nice consistent return of 10% per year. This investment doesn't require any upfront knowledge about the stock market. It's a collection of companies like Facebook, Google, Tesla, all of these big branded companies that have stood the test of time and are some of the biggest in the world. So your $1,000 will be spread out amongst these giants, and you know that you can secure yourself a nice consistent return because all these companies balance each other out, and if some are doing poorly, others will be gaining value, and this will even out to a nice consistent return over time. If you want a bit more information on this investment, check this video out on screen that will give you a complete step-by-step guide and all the information that you need about it. If you're wanting to invest in this company, there's lots of free brokerage platforms that you can use. If you're in England, there's Webull or Freetrade. In America, there's Robinhood, and if you're in Australia or New Zealand, there's Stake. These platforms are all very easy to follow and beginner friendly, and you can buy shares in companies with just a few clicks of a button. You can access them both on your computer or phone, and it's a very straightforward way to get into investing. Of course, investing can take up a lot of your time if you're wanting to research companies or invest into individual stocks, but if you're looking at maybe more blue chip or more established businesses like investing in Google or Facebook, this again is also a very safe strategy. But in a nutshell, investing doesn't have to be something that takes lots of effort, but it just depends on what kind of companies that you want to invest into. Either you can spend virtually no time looking at the stock market, or you can spend hours researching companies if you're looking at more speculative investments that require a bit more knowledge to make sure that they are actually worthwhile. Because investing now is a lot more worthwhile than investing later. The earlier you get your money into the market, the greater it can compound and grow over time. Going back to that S&P 500 ETF, the returns on this can be staggering. If you're actually consistent enough and put in say $400 a month, which is roughly $100 a week, then you can total a return of $1 million. And thinking about that, that's only roughly $15 a day that you would have to routinely put into this investment to get those staggering returns. The biggest thing to keep in mind with your investing is that the money you put into the market, you can't need to use it. It has to be able to stay there and grow its value over time. If you're putting in money that you need for necessities like paying for gas or buying food, then you're going to have to keep pulling that money out of the market and using it to buy other things. So I like to allocate a percentage of my money to investing. Roughly, I'm putting about 20 to 30% of my weekly paycheck into the market and making sure that I keep track of everything. The more you measure something, the more it grows, and the better it will be for you if you can keep track of everything and make sure you're allocating your money productively to something that will actually make it grow value over time as opposed to just spending it. Number 4 is getting a part-time job, whether you're at school or university, and this will put things into perspective on how much stuff really costs, because a good way to look at the price of something is to think about how many hours you would have to work in order to get it. Those $120 pairs of shoes, if you're only getting $20 an hour from your part-time job, will take 6 hours of your time, and that makes them seem a lot less worthwhile because you're thinking about all the time that you have to trade just to get them. And then you can see if it's really worthwhile buying lots of material things because they just give you that momentary satisfaction but take hours of your time to get. Whereas if you put your money into the stock market, you're spending that time, that energy you've needed to create or to get that money and putting it somewhere productive where it generates more money for you. If you look at your stock market gains as time that you've saved for yourself, that you don't need to work a regular job to get that money, then it seems much more beneficial and a lot better for you. If you make $120 on the stock market, then you've saved yourself 6 hours of time that you would have normally had to work, because money is the best worker. If you can use it effectively, it'll work 365 days a year, 24 hours a day. When you're asleep, your money will be working for you if you have it invested, and it will be productive and generate you more income. And the more money that you make in the stock market, the more time that you save for yourself. Number 5 is having the right mindset about investing. Not thinking about investing as something risky or that will cause you to lose money, but instead looking at investing as an opportunity to make more money, an opportunity to set yourself up financially and to build good habits habits for yourself that will set you up for your future. What really is risky is not investing any of your money. If you just have your money sitting in a savings account, which gives you virtually nothing in return, maybe 0.5 to 1.5% interest, and then if you take inflation, which averages 2 to 3% per year, then you're quite literally losing money if it's just sitting in a savings account. And also, if you don't get into investing, it makes it a lot harder to learn about money and how to use it effectively, because investing can definitely be risky if you're just following trends and buying things that you don't know about. But a great strategy for the stock market is to have 80% of your money in an ETF that tracks the overall market performance, like those offered by Vanguard or iShares, and then having 10% in a growth-based ETF that tracks some of the newest and most growth-based companies. For me, I like the ARK Innovation ETF that tracks new and up-and-coming businesses like Tesla, Roku, and Square, and this has a lot of growth potential behind it, and your money is diversified through a lot of companies that have seen hundreds of percentage gains over the past few years. And then the final 10% you can put into more speculative investments, things like crypto or individual companies, and this is if you want to spend some time researching and looking into things and want to have some money set aside. Doesn't matter if you lose it or not, because it's only 10% of your portfolio, but again, it gives you access to those investments that can give you a massive return, but you're not allocating too much of your portfolio, so you get that nice consistent growth from the ETFs, and then that chance for those massive gains in a short amount of time with those more speculative investments that you buy, either crypto or individual companies. Buying and holding is arguably the best strategy that you can have in the market. Routinely timing buying and selling points perfectly to buy in at the lowest price and sell at the top is virtually impossible, and it's not something that you can routinely replicate. It takes a lot of time and energy, so I would say just buying and holding, investing in the companies for better or for worse, is the best strategy for you. The whole time it's invested in the market, it can grow its value. Of course, there's lots of ups and downs, and you're not always going to be making a profit the entire time, but the longer you leave it invested, the more it can grow and the greater the reward that you will get. You might hear people saying that the market is overvalued or you shouldn't be buying shares right now because everything costs too much, but in 3 to 5 years time, the value of the market now will seem like a bargain. It's always going to be increasing in value, so getting in the earlier the better is the best option for you. You don't want to be sitting on the sidelines missing out on profits because you're trying to perfectly time the best point to buy in. Now that you know my top 5 tips for investing in your 20s, you might be interested in learning about some common investing mistakes. Check out this video on screen to see my top 7 investing mistakes to avoid, and these are things that I wish I knew earlier. It would have saved me a ton of time and money, so check this video out so you don't make the same mistakes that I did.